Most people wake up every morning working for a bank without even realizing it, letting their hard-earned savings melt away by exactly 4% every single year, while the institutions they trust use that same capital to build massive empires. You are essentially paying a penalty for being responsible, and if you do not change your strategy right now, you are going to retire with a number that looks big on paper but buys absolutely nothing. So in this video, we're going to separate what's real from what's just hype. By the end, you'll walk away feeling calmer, clearer, and far more confident about what you're actually buying, and more importantly, why you're buying it. Drop a comment below and let me know the exact day and date you're watching this from. I love seeing where and when you're tuning in. And real quick, if you appreciate content that's built from scratch, thoughtfully researched, and never copied, support the channel by subscribing and commenting Henry's Market HQ below. It helps this channel grow more than you think, and I truly appreciate it. To understand why your relationship with your bank is fundamentally broken, you have to look at a startling reality that most people ignore. The average traditional savings account in the United States currently offers an interest rate that is effectively a rounding error, while the bank turns around and lends that exact same money to your neighbor at 24% interest via a credit card. Think about that massive gap for a moment, because it represents the silent transfer of your potential wealth into the pockets of shareholders who already have more than they can spend. Back in 1971, the entire financial landscape shifted when the link between the dollar and gold was severed, turning our currency into a system based entirely on debt and trust. Before that moment, money represented a physical claim on a tangible asset. But today, your money is essentially a digital entry in a ledger that the bank treats as a liability they want to minimize while maximizing their own leverage. When you deposit $1,000 into your account, the bank does not just let it sit in a vault like you see in the old movies. Instead, through a process known as fractional reserve banking, they are legally permitted to lend out the vast majority of that deposit. This creates a cycle where the bank creates new money out of thin air every time they issue a loan, effectively diluting the value of every dollar you have tucked away for your future. It is a system designed to reward those who move money and penalize those who simply store it. Imagine working 40 hours a week, sacrificing your time with your family and your personal passions, only to hand that energy over to an institution that pays you a fraction of a percent in return. Meanwhile, inflation is the invisible thief that never sleeps, eroding the purchasing power of your savings every single day. If inflation is running at 5% and your bank is paying you 0.5%, you are effectively losing 4.5% of your wealth every year just for the privilege of keeping it in a safe place. The true cost of this safety is the slow-motion destruction of your financial freedom. Most people think they are being conservative by keeping cash under the digital mattress of a big-name bank, but they are actually taking the biggest risk of all, the risk of outliving their money because it failed to grow alongside the cost of living. We were taught from a young age that savers are winners. But the rules of the game changed decades ago, and the playbook hasn't been updated for the average person. The banks rely on your lack of knowledge and your fear of the unknown to keep the status quo alive. They want you to feel that the stock market is a gamble and that alternative assets are too complex for the common person to understand. By keeping you in a state of financial hesitation, they ensure a steady supply of cheap capital that they can use to fund their own high-growth investments. It is a brilliant business model for them, but it is a slow-burning disaster for you. You have to realize that the bank is not your friend. It is a business with a primary fiduciary responsibility to its own profit margins, not your retirement goals. They spend billions on marketing to make you feel like they are a neighborly presence in your life, using warm colors and friendly faces in their commercials. But their balance sheets tell a very different story. Every fee you pay, every low-interest month you endure, and every time you choose their convenient products over a more lucrative path, you are funding their success at the expense of your own. This matters right now because we are living through a period of unprecedented economic volatility, where the gap between the wealthy and the working class is widening, not just because of income, but because of financial literacy. Understanding the mechanics of how money is created and moved is the only way to protect yourself from being a casualty of a system that views you as a data point rather than a human being with dreams. The foundational truth is that cash is a melting ice cube, and if you do not learn how to move that ice into a freezer that actually works, you will be left with nothing but a puddle when you finally reach the age where you want to stop working. This is not about being greedy. It is about being strategic and recognizing that the traditional advice our parents followed is no longer applicable in a digital, debt-based economy. We are seeing a massive shift in how value is perceived and stored, and the people who recognize this early are the ones who will thrive while others struggle to keep their heads above water. The bridge between where you are and where you want to be is built on the information that the big institutions would rather you not focus on. If this is making sense so far, go ahead and hit that like button. It genuinely helps this channel reach more people just like you. Now, we need to go deeper into the mechanics of what happens behind the closed doors of the investment committees that run these massive financial organizations. Because what they do with their own capital is the exact opposite of what they tell you to do with yours. While they encourage you to keep your money in a liquid savings account for emergencies, they are aggressively moving their own assets into productive machines, real estate, and sophisticated debt instruments that generate cash flow regardless of what the broader market is doing. They understand a secret that most people never hear. The velocity of money is more important than the amount of money. Velocity is the speed at which your dollars are working for you, moving from one investment to the next, compounding and creating babies that then go out and create more babies. When your money sits in a bank, its velocity is 0 for you, but it is moving at light speed for the bank. And this is where most people stop reading, stop watching, stop paying attention. But the ones who stay are about to understand something that could completely change how they see their money and their future. The real secret is that the bank uses your deposits as collateral to borrow even more money from the central bank at even lower rates, creating a leveraged sandwich that generates billions in pure profit. They are playing a game of arbitrage, which is simply the act of buying low and selling high. But they are doing it with the very essence of your labor. One of the most shocking facts that many people find hard to believe is that during periods of high inflation, the debt that banks hold actually becomes easier for them to pay off, while the value of your savings shrinks. They are essentially shorting the dollar using your deposits as the fuel. If you want to break free from this, you have to start thinking like the institution rather than the customer. A counterintuitive truth that stops most people in their tracks is that safe investments are often the most dangerous over a 30-year horizon. If you choose the safety of a 2% bond or a 1% savings account, while the cost of housing, healthcare, and education rises by 7% annually, you are guaranteeing a loss of lifestyle. You aren't avoiding risk, you are guaranteeing a negative outcome. The calm but urgent reality is that the financial system is currently designed to transfer wealth from the patient saver to the impatient borrower and the sophisticated investor. You have to decide which side of that equation you want to be on. Most people think they are diversified because they have money in a few different bank accounts, but true diversification means owning things that the bank cannot inflate away or control. This includes shares in companies that have the power to raise prices during inflation, real estate that provides a tangible utility, or even skills that make you indispensable in the marketplace. The banks don't want you to realize that you have the same tools at your disposal that they do, albeit on a smaller scale. You can participate in the growth of the global economy through low-cost index funds that bypass the high fees of traditional wealth management services that banks love to push. These services often charge you 1 or 2% of your total assets every year just to put your money in the same products you could buy yourself for almost nothing. Over a lifetime, a 2% fee can eat up nearly half of your total investment gains. Let that sink in for a second. Half of your potential wealth, gone, just to pay for a suit and a fancy office in a downtown skyscraper. The urgency here comes from the fact that time is your greatest asset, and every day you leave your capital in an underperforming environment is a day of compounding you can never get back. We are taught to be afraid of market volatility, but volatility is simply the price of admission for long-term growth. The bank uses your fear of a temporary dip in the market to keep you trapped in a permanent dip of purchasing power. You have to cultivate the emotional discipline to see through the headlines and the noise. When the news says the market is crashing, the banks are often the ones buying the dip, using the very capital that scared retail investors just pulled out of their accounts. It is a cycle of wealth transfer that happens every decade like clockwork. By understanding these patterns, you stop being a victim of the cycle and start becoming a beneficiary of it. You begin to see that money is not a static object to be hoarded, but a dynamic tool to be deployed. The transition you need to make is from a consumer mindset to an owner mindset. Instead of being the person who pays the interest, you need to become the person who receives the dividends. This shift in perspective is the threshold between financial stress and financial sovereignty. The resolution you have been waiting for isn't a complex trading strategy or a lucky break. It is the deliberate choice to take back control of your capital and place it where it is treated with the respect it deserves. To do this, you need to follow a few specific, actionable steps that strip away the bank's power over your future. First, you must redefine what an emergency fund looks like. While you need some liquid cash for immediate needs, anything beyond 3 to 6 months of expenses should be moved into assets that historically outpace inflation. If you have $50,000 sitting in a standard checking account, you are losing thousands of dollars in opportunity cost every single year. Second, look into high-yield cash management accounts or treasury bills that offer significantly higher rates than traditional banks while maintaining a high degree of safety. These tools are often just as easy to use, but are not marketed by the big banks because they aren't as profitable for them. Third, automate your move into the owner category by setting up recurring investments into broad market index funds that give you a piece of the world's most profitable companies. By doing this, you are no longer just a customer of the economy. You are a shareholder in it. I want to be clear, I'm not here to sell you anything. I'm here because this information changed the way I think about money, and I want it to do the same for you. I remember the feeling of looking at my bank statement and wondering why, despite working harder than ever, my balance didn't seem to buy as much as it used to. It was a realization that felt like a punch to the gut, but it was the catalyst I needed to stop playing the bank's game and start playing my own. I know many of you are feeling the weight of debt, the confusion of 1,000 different investment options, and the genuine fear that you might never be able to truly retire or provide the life your family deserves. That fear is real, but it doesn't have to be your permanent reality. The financial world is designed to look complicated so that you'll pay someone else to handle it for you. But once you peel back the layers, the principles of wealth are actually quite simple. It's about spending less than you earn, investing the difference in productive assets, and having the patience to let time do the heavy lifting. The bank wants you to think you need a complex product, but what you actually need is a simple process. When you stop looking for the next hot tip and start focusing on the long-term math, the anxiety begins to fade. You start to see your money as a fleet of soldiers that you are sending out to capture more territory for your future self. Every dollar you invest today is a seed for a tree that will provide shade for you 20 years from now. Don't let the bank eat your seeds. Take them back, plant them in fertile soil, and protect them from the pests of inflation and high fees. This journey to financial clarity is not about getting rich overnight. It is about ensuring that you are never a slave to a paycheck or a predatory interest rate. It's about the peace of mind that comes from knowing that your money is working just as hard for you as you worked to earn it. We live in an era where information is abundant, but wisdom is scarce. The wisdom here is to trust the math over the marketing. Look at the numbers, look at the historical returns of different asset classes, and look at the actual inflation rate at the grocery store. When you align your actions with the reality of the economy, rather than the promises of a bank's brochure, you become unstoppable. You are the CEO of your own life, and your bank is merely a vendor. It is time to start treating them like one. Renegotiate your relationship with your finances. Demand more from your capital. Be the person who asks the hard questions and seeks out the truth behind the standard advice. Your future self is counting on the decisions you make today, and by simply choosing to be more aware and more intentional, you are already ahead of 90% of the population. This is how you build a legacy. This is how you break the cycle of living paycheck to paycheck. This is how you win. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early.